Welcome to the market update for the second quarter. During our last update in April, we noted that a high level of market uncertainty was expected, exacerbated by the war in Ukraine and soaring inflation. While inflation has been the most watched theme, we're now witnessing weakness in consumer sentiment and in commodities. Combine this with lower yields indicates that the market is moving from fears of inflation to fears of a significant economic slowdown or recession. Dave will talk more about this shortly, so I'll just point out that this is reflected in the market for the quarter and for the first half of the year. As you can see, this is an extremely difficult start to the year, with the only two asset classes showing positive returns being cash and commodities. The S&P 500 lost 20% in the first half of the year, and international stocks, represented by the MSCI EAFE index, lost 19.6%. Bonds also struggled this quarter, with the Bloomberg Aggregate Bond Index losing 10.3%. To put this in perspective, research from Deutsche Bank shows that this is the worst start to the bond market since 1788. Yes, you heard that right, over 200 years ago. This has effectively been the worst start to the bond market in history. For long-term investors with balanced portfolios, like most of Wespath's clients, this resulted in the worst performance for a traditional balanced portfolio since the Great Financial Crisis in 2008. Looking at a traditional 60-40 portfolio using the S&P 500 and the Bloomberg Aggregate, the 2022 year-to-date loss is 16.1%. The worst full-year performance in the last 45 years was negative 20.1% in 2008. And we've already reached 16% in just 6 months. You can see from the chart it's very rare to have double-digit losses in a balanced portfolio. Typically, stocks and bonds are negatively correlated, or at least uncorrelated, so they will not move in the same direction. What's different this time is very high inflation, which we've not experienced at this level for 40 years. To combat inflation, interest rates rise, which in turn causes bond prices to fall and results in negative returns. Higher rates makes equities less attractive, especially growth stocks. And remember, growth stocks have led U.S. markets higher for the last decade. Higher rates will slow the economy, which is needed, but also weigh on earnings and consumption, and it's a big headwind for stocks. This helps explain why current market conditions are rare, where bonds do not offer protection in a diversified portfolio. It also explains why central banks fear inflation. Let's review the bond market and yield curve reaction to the sharp rise in inflation. To start the year, the 2-year yield stood at 73 basis points. By the end of June, the 2-year yield had risen by 2.35%. A significant move in just 90 days. Looking at the yield curve from the bottom blue line to the orange top line, that represents a difference that we've seen over the last 6 months. We saw very sharp moves higher in the short end, up 2% out 3 years, and 1.3% in 30-year rates, resulting in bond losses across all maturities. While the losses from the bond market are palpable for the first half, bonds are much more attractive today than they were at the start of the year. An investor has a year of 3% on a 10-year bond, and that's double the 1.5 from the start of the year. The Fed hiked rates 50 basis points on May 4th and 75 basis points on June 15th to a new range of 1.5 to 1.75%. There is an additional 200 basis points priced into the futures market for the rest of 2022, including another 75 to 100 basis points in July. Looking at the green line in this chart, the market is already pricing in Fed rate cuts for 2023. This is because the market is forward-looking and already predicting that the economy will slow and inflation will come down to the point where the Fed will switch to easing next year. This is a positive sign and suggests that even as we live through this volatility, the imbalances are being adjusted and we will see growth after this short-term turmoil. One way to look at how the market is adjusting is to look at 5-year break-even rates, which are real-time estimates from yield curves on future inflation. We hit peak 5-year inflation expectations in April of 3.6%. At the end of June, it's down to 2.6%. If inflation expectations continue to ease, it's possible that the Fed will not have to hike by the further 200 basis points currently priced in, and this would be a positive for asset prices. I want to look at 2 equity market graphs for some perspective. We frequently show this chart on the screen, and this shows the S&P 500 performance over time. you'll see that the gray bars represent calendar year returns and the red dots show the largest intra-year peak to trough drawdown. For 2022, the performance is through June. Since 1980, the average return on the S&P 500 was 13%. However, during the year, on average, there is a peak to trough decline of 14%. So this is a great visual reminder that drawdowns are completely normal. And in order to achieve overall positive long-term performance, an investor needs to assume some level of short-term risk. Another factor related to equities in this drawdown is that valuations have come down considerably. While no one ever wants to see double-digit losses in the first 6 months of a year, stocks are much more reasonably priced when looking at traditional metrics. One measure we consider when looking at how cheap or expensive the market is the forward price to earnings ratio. After peaking near 23 at the end of 2020, this ratio now stands at just under 16, which is sharply lower and also below the long-term average of 16.85. While I've reported some ugly market results for the first half of 2022, I want to try and end on a positive note. Recent commentary for Dr. David Kelly of JP Morgan Asset Management notes that since 1946, the average recession has lasted for 10 months, and the average expansion has lasted for over 5 years. Again, while recessions are challenging, historically they are short-lived. While the economy and markets have been somewhat unnerving for the past 18 months, this is a period of post-COVID adjustment. Imbalances are being resolved, and we're also adapting to a new normal, including hybrid work and more resilient supply chains. We believe that the US and the world will resolve current challenges and that economic growth will continue.